Good morning, everyone. It is a pleasure to welcome you to Frankfurt and to EIOPA's 15th anniversary conference, Supervision with Impact. This year marks 15 years since EIOPA was established. Over the past decade and a half, EIOPA has shaped insurance and pension supervision in Europe, strengthening financial stability and, crucially, reinforcing trust for European consumers. Today is both a moment to reflect and to look ahead. As EIOPA enters its next phase, our discussions will focus on how supervision can continue to deliver tangible, real-time impact and in a rapidly changing environment. It is my great pleasure to introduce our opening keynote speaker, Klaas Knot. Klaas is the former president of the Nederlandsche Bank and former chair of the Financial Stability Board. Who could be better placed to reflect on the evolution of financial supervision and the challenges ahead? Klaas, thank you very much for being with us today. Here, the floor is yours.
Well, good morning, I would say, to everyone, and thank you for inviting me. A special thanks, of course, to Petra. It's been wonderful to catch up again. I mean, you should know that Petra and I go back already to 2007, when I was still heading up the supervisory policy division at the bank, and Petra joined. And guess what? Within 3 weeks, I was going to the CEOPS managing board, where I was a member of then. I look back and, hey, this backbencher, it's Petra. No surprise, because a former colleague of mine once said about Petra, you know, she's the type of person, if you drop her out of a plane somewhere in the world, and then a year later you come back where she landed, most likely she will have become the mayor. Okay, but as you can see, I mean, we're not here to celebrate Petra. We could go on and on and on. We're here to celebrate, of course, EIOPA. EIOPA, 15 years of EIOPA, time flies, and this conference is, of course, a fantastic moment to reflect and look back a little bit. So if you then, in my position, start preparing yourself for a conference on an entity that exists for 15 years, so what is a nice metaphor that I could use? Is there perhaps an iconic pop song about turning 15? So I Googled a little bit, and guess what? Check! Taylor Swift. This should appeal to you, right? Okay, one of her lyrics goes as follows. When you're 15, feeling like there's nothing to figure out, well, count to 10, take it in. This is life before you know who you're gonna be at 15. Who would disagree with her, right? So, but then you grow older, and you get a little bit wiser, and you look back, and you wish you could give some advice to your younger self. Like, slow down, take a step back, pause for a second. Well, that happens to be exactly what EIOPA is doing today, right? It is counting to 10, take it in at 15, like Taylor Swift sings. And this actually shows how mature the organization already is today. Indeed, for 15 years already, you have been strengthening the European insurance and pension sector. You have been building resilience through Solvency II and other measures. And you have been playing a vital role in the European financial system. And that deserves a celebration. So also on my behalf, congratulations to EIOPA. But as former chair of the Financial Stability Board, you're seldomly invited to just celebrate. Typically, you're invited to also sound a little bit of a warning. As it so happens, Taylor Swift also sings, "This is life before you know who you're gonna be at 15. So at 15, you're still so young, and life's big challenges still lie ahead of you. And so even though EIOPA is pretty mature at 15, it's also still young. And the future will surely test what this organization stands for, who it is in the face of big, big challenges. And there will certainly be challenges ahead. Today, I would like to highlight one of these challenges. So after heading the supervisory policy division that I just talked about, I became president of DNB in 2011. And back then, our main concern was actually the banking system. Commercial banks had extended large amounts of increasingly risky credit to the private sector, and this led to significant financial imbalances. Today, however, the biggest threats to financial stability may lie outside traditional banks, in the realm of what we call non-bank financial intermediaries, or in short, NBFI. Because today, what we are facing is an uncomfortable mix of record-high public debt combined with a rapidly growing NBFI sector. Public debt in advanced economies is now at levels that we haven't seen since the aftermath of World War II. According to the IMF, sovereign debt in these economies is projected to reach 120% on average, 120% of GDP by 2030. And if we factor in demographic pressures, the green transition, and rising defense spending, the trajectory may become even steeper. So without meaningful fiscal consolidation, advanced economy debt levels could climb to 170% of GDP by 2050. At the same time, the structure of financial intermediation has undergone a profound transformation. Since the global financial crisis, commercial banks have been subject to tighter regulation. They've strengthened their capital and liquidity positions and now have fewer incentives to take excessive risk. As a result, commercial banks' total assets have increased at a relatively moderate pace. And this created a gap where NBFIs stepped in to fill it. According to the FSB's annual monitoring exercise, between 2008 and 2023, the global assets of NBFIs grew by 74 percentage points of global GDP. Commercial banks, by contrast, only grew by 17 percentage points of GDP. So while we have effectively made the banks safer, the risks did not disappear. They just migrated. Think of it like a waterbed. You push down in one place, it pops up in a different place. And such migration actually matters. Today, NBFIs are the new backbone of sovereign debt financing. And that poses new challenges in and of itself. To understand these challenges, I think it's useful to distinguish between two broad categories of investors in the NBFI realm. Two categories with different incentives and reactions to stress, but with a similar capacity to create or to amplify stress in the financial system. The first category consists of what I would call leveraged speculators, hedge funds and similar entities. They use very short-term funding and high leverage to chase arbitrage opportunities. Between 2008 and 2023, hedge funds and money market funds expanded their holdings of sovereign debt from 13 to 18% of GDP. And the strategies of this first category can be very profitable. They are typically quite profitable, but they're also quite risky. A most concerning development in recent years has been the rise of extreme leverage in parts of the non-bank sector. For example, when we look at hedge funds using repo markets to finance sovereign bond trades, we see that in 2025, around 56% of bilateral repo transactions by hedge funds in US Treasury markets were conducted with zero haircuts. Zero haircuts. And that means borrowing the full amount of the collateral, or sometimes even more, without any buffer. And that to me sounds worrisome, to say the least. Now the second category consists of what we call real money investors. Real money investors, like insurers, like pension funds, like sovereign wealth funds, typically they have a longer term horizon. They have longer long-term liabilities and investment horizons, and they tend to be more stable, patient, and focused on matching assets with liabilities. Between 2008 and 2023, this category of investors increased its total financial assets, including sovereign bonds, from 82% of global GDP to 135% of global GDP. Also, they have proven to be a potential risk to financial stability. Just recall the UK gilt market crisis of 2022. A sudden spike in yields triggered margin calls on derivative positions held by pension funds. And to meet those calls, funds had to sell gilts, and this pushed prices down even further, triggering more margin calls. It was a classic feedback loop that is an essential part of systemic risk. And it came from a part of the system that many would have assumed beforehand was stable. Today, both these leveraged speculators, but also these real money investors, are deeply embedded in sovereign bond markets, each posing their own risks. And on top of that, these risks can interact. If leveraged players have to unwind positions, they can trigger price movements that affect real money investors. And if those investors are themselves exposed to derivatives or liquidity mismatches, they also can be forced to sell. And then, next to these mutual interactions, there's not just the potential to interact amongst themselves, there's also a potential interaction between NBFIs and commercial banks. One important interaction arises when leveraged funds borrow from banks, and that is quite a common occurrence. And this means that stress originating in the NBFI sector can quickly spread to the traditional bank sector. Hence, there is a need for what is called congruent regulation. When different actors take on similar risks, there should be similar safeguards in place. Not identical, but comparable expectations for leverage, for liquidity, for transparency. The shifting risks that I just mentioned show that vulnerabilities are not neatly confined to just one corner of the financial system. They typically appear in different parts simultaneously. And one fast-growing example, with many of the same warning signs, is private credit. From just over $1 trillion in 2019, it grew to over $2 trillion in 2024. About 80% of this is in North America, where private credit now accounts for 7% of total credit to non-financial corporates. And let there be no mistake, private credit offers real benefits. It provides financing to companies, often small and medium-sized, that might not have access to public markets. It has traditionally offered higher returns to investors, and often that was accompanied by strong governance and by tailor-made structures. It has also attracted institutional capital, including from insurers that were seeking yield, but also a bit of diversification. So, a successful asset class. But here's the but. It also carries some risks. First of all, private credit is inherently opaque. They are private deals with limited disclosure. Valuations are quite uncertain. Ratings cannot easily be validated. So in order to assess this risk, we would need better data, because as too often is the case in NBFI, we don't know who holds what, and we don't know how they are funding it. And that is not acceptable in a world that is so interconnected. Second, having become sizable only in recent years, the market is by and large untested. It's a fair weather asset class that has not yet gone through a full credit cycle at its current size. What would happen if the credit cycle were to go down? Are there the similar sort of workout procedures that we know from the banking sector, where there are specific departments for distressed credits, etc.? To my knowledge, they're not in place. So what will happen then? Do we get new rounds of procyclicality, that we pushed out of the banking sector so much by increasing capital and that we now could get back through the back door. And finally, there are also growing signs of increasing retail exposure. While this asset class, of course, initially targeted a sophisticated investor base, some funds are now being marketed to retail investors who may not fully understand the risk or be able to come to a risk assessment. And finally, also here, of course, there is leverage, and some of the leverage may be hidden, it may even be layered, and that may then, in a downturn, create the potential to amplify losses. Looking at you here at this conference, insurers are not just passive observers to this market. Insurers are active participants. In Europe, insurers have steadily increased their allocations to alternative and illiquid assets, reaching around 17.5% of their portfolios by 2025. And that shift has helped improve returns, and it has helped to match longer-term liabilities. But it has also exposed the insurance sector to the same risks that we see in the broader NBFI space. Now, insurers, of course, have structural strength. They have long-dated liabilities, they're not subject to deposit runs, but they are not immune to stress either. And policyholders can increasingly surrender their policies. Market losses can erode solvency. And where many insurers follow similar strategies, they risk correlated exposures. Now, the good news is that the supervisors are very, very much aware of this issue, and they're also responding to it with impact. As such, EIOPA, for instance, is enhancing its stress testing. It is improving its data collection. And it is working with the other regulators in the world to monitor cross-sectoral risks. The other regulators, not only in the world, but also of the other sectors of the financial system. And all of this is there to ensure that your sector can actually absorb shocks, not amplify shocks. And all of this to ensure supervision with impact, which is the theme of today's conference. And as I said, this is not only happening in Europe, it's happening globally too. I had the honor to chair the Financial Stability Board from 2021 to 2025, and we too made NBFI a priority by working our way through a multi-year roadmap on NBFI reforms. In July 2025, we published recommendations to address leverage in NBFIs. And as such, we called for better risk monitoring, for minimum margining standards, for more transparency, and for cross-border cooperation. These are all not abstract goals. They are very much essential for our common goal, which is financial stability. Because the next crisis, as I said, may not start at a bank. It may start at a hedge fund or a private credit fund or a corner of the market that we may not have been watching closely enough. We just don't know. So let me wrap up. Taylor Swift's song 15, it is essentially a song about friendship, about first loves, and the dramatic lows and highs and lows of high school. But being 15 could also be widely different. Just ask Ed Sheeran, another singer. This is a lyric from him, 15 years old and smoking hand-rolled cigarettes, running away from the law through the backfields and getting drunk with my friends. That's what he thinks about getting 15. That also is just what it is, right? At 15, some are still figuring things out, while others are already showing who they are becoming. And EIOPA? Well, I think you clearly belong to the latter group. At 15, you have shown maturity, you've shown ambition, you've shown a clear sense of purpose. So if I were you, I would switch to another Taylor Swift tune. And go like, hey, I don't know about you, but I'm feeling 22. I thank you very much for your attention. Thank you.